Welcome back to Centrelink Insider AU, the channel that makes sure you get every dollar you are entitled to in retirement. If you are new here, subscribe right now and turn on notifications because we cover Centrelink, the age pension, deeming, and every rule that affects your retirement income every single week. And share this video with every pensioner you know, because the March 2026 deeming change has already affected the pension payments of over 1 million Australians, and most of them have not yet understood why their payment changed. Now, let us get straight into it. Let me start with the most fundamental question. What is deeming, and why does it exist? Because before you can understand how your bank account is affecting your pension, you need to understand the system that connects the two. When Centrelink assesses your age pension entitlement under the income test, it does not look at what your financial assets actually earn. It does not check your bank statement. It does not ask what interest rate your term deposit is paying. It does not look at your share dividend statements. Instead, Centrelink applies a set of assumed interest rates to your total financial assets and calculates a deemed income from those assets, regardless of what those assets are actually returning in the real world. This assumed income is then counted in your income test assessment. If your total deemed income plus any other assessable income is above the income-free threshold, your pension starts to reduce. The system does not respond to how much your assets actually earn. It responds to how much Centrelink assumes they earn based on the deeming rates. The deeming rate is the answer to why a reader's fortnightly pension fell by a few dollars despite nothing changing in her bank account. When Centrelink works out your age pension under the income test, it does not look at what your savings, term deposits, shares and managed funds really earn. It applies an assumed rate, the deeming rate, and counts that as your income. The logic behind deeming is straightforward. Without it, pensioners could park all of their money in a zero-interest account, declare no investment income, and receive a full pension regardless of their actual wealth in financial assets. Deeming prevents that by assuming your money is generating income at a standard rate regardless of where it sits. It also simplifies the Centrelink system enormously. Without deeming, Centrelink would need to verify the actual returns on every single financial asset held by every single pensioner every single fortnight. That would be administratively impossible. Deeming provides a reasonable approximation that can be assessed without that verification burden. Now, here is where it gets critically important for every pensioner with a bank account. The deeming rates are not fixed permanently. They change. And the change that happened on the 20th of March 2026 was the largest single adjustment to deeming rates in years. For 6 years, from May 2020 through to March 2026, the deeming rates were frozen at emergency pandemic lows. On the 20th of March 2026, the federal government allowed Australia's social security deeming rate freeze to thaw, sending the lower deeming rate from 0.25% to 1.25%, and the upper rate from 2.25% to 3.25%. For the 2.5 million Australians who depend on the age pension, this is the most significant change to payment calculations since 2020. Let me make sure you understand exactly how large this change was. The lower deeming rate went from 0.25% to 1.25%. That is a 5-fold increase. The upper deeming rate went from 2.25% to 3.25%. That is a 44% increase. For pensioners with significant financial assets, this change meant a sudden and meaningful increase in their deemed income, which translated directly into a reduction in their pension payment. And from 1 July 2026, the deeming thresholds were updated. From 1 July 2026, the deeming rates are, for singles, 1.25% on the first $66,800 and 3.25% on the balance. For couples, 1.25% on the first $110,600 and 3.25% on the balance. Now, let me show you exactly what this means in dollar terms, because I want this to be completely concrete rather than theoretical. Our first example is a single pensioner named Margaret, with $200,000 in financial assets consisting of $150,000 in a savings account and $50,000 in a term deposit. Before March 20th, under the old deeming rates, her deemed income was calculated as follows. The first $64,200 was deemed at 0.25%, producing $160.50 per year in deemed income. The remaining $135,800 was deemed at 2.25%, producing $3,055.50 per year in deemed income. Her total deemed income was $3,216 per year, or approximately $123.69 per fortnight. Since the income-free threshold for a single pensioner was $218 per fortnight, Margaret's deemed income was well below that threshold. Her pension was not reduced by the income test at all. She was receiving the full pension. After March 20th, under the new deeming rates, Margaret's calculation changed significantly. The first $64,200 was now deemed at 1.25%, producing $802.50 per year in deemed income. The remaining $135,800 was now deemed at 3.25%, producing $4,413.50 per year in deemed income. Her total deemed income jumped to $5,216 per year, or approximately $200.62 per fortnight. That is still below the $218 income-free threshold, so Margaret's pension was not directly affected by the income test, but she came very much closer to the threshold than she was before. And if she has any other income, such as a small investment return or occasional work income, the higher deemed income could push her over the threshold and reduce her pension. Now, let me run the same example with a larger financial asset base to show where the impact becomes immediately and significantly real. Our second example is a single pensioner with $350,000 in financial assets. Before March 20th, their deemed income was calculated as follows. The first $64,200 at 0.25% produced $160.50 per year. The remaining $285,800 at 2.25% produced $6,430.50 per year. Total deemed income was $6,591 per year, or approximately $253.50 per fortnight. That is above the $218 income-free threshold by $35.50 per fortnight. Their pension was reduced by 50 cents for every dollar above the threshold, so they lost $17.75 per fortnight in pension, or approximately $462 per year. After March 20th, the same person's deemed income changed dramatically. The first $64,200 at 1.25% produced $802.50 per year. The remaining $285,800 at 3.25% produced $9,288.50 per year. Total deemed income jumped to $10,091 per year, or approximately $388.12 per fortnight. That is $170.12 above the income-free threshold of $218 per fortnight. Their pension is reduced by 50 cents for every dollar above the threshold, so they lose $85.06 per fortnight in pension, or approximately $2,212 per year. The pension reduction more than quadrupled, from $462 per year before the deeming changed to $2,212 per year after it, purely because the assumed return on their bank account went up, even though their actual bank returns may not have changed at all. That is a real financial impact of $1,750 per year on a single pensioner, driven entirely by a change to an assumed interest rate. Let that sink in. Now, our third example illustrates the most painful version of this situation. It is a pensioner who holds their savings in a transaction account or basic savings account that is earning close to nothing, perhaps 0.5% per year. Under the old deeming rates, being assessed at 0.25% and 2.25%, was already higher than the actual return on cash savings. But under the new deeming rates of 1.25% and 3.25%, if your savings earn less than 1.25%, the gap between deemed and real income is costing you pension dollars that are not returning any actual investment income. This is the scenario where the bank account is costing pensioners the most in lost pension. Centrelink assumes the money is generating income that does not exist, and the pension is reduced accordingly. The fundamental unfairness that some pensioners feel about deeming comes from exactly this scenario. They are being penalized for holding money that they are told is generating a 3.25% return, when in reality it might be earning 0.5% or even nothing. The pension reduction is real. The income it is based on is not. Now, I want to address something directly, because I know some people watching this are wondering whether there is any way to legitimately avoid or reduce the pension impact of their bank savings. And the honest answer is yes. Within certain boundaries, there are legitimate strategies that financial advisors use to help pensioners reduce the pension impact of their financial assets. Let me walk through each of them clearly. The first and most straightforward strategy is to make sure your savings are actually earning close to or above the deeming rate. In a world of higher interest rates, a good saver can earn more than the deemed rate suggests, and that gap works quietly in their favor. The reverse is the trap. The government still deems money sitting in a transaction account earning next to nothing to earn 3.25% on most of it. If your bank account is earning 0.5% and Centrelink is assuming it earns 3.25%, the deeming system is costing you twice. First, in pension reductions based on assumed income that does not exist, and second, in foregone actual interest income that your money could be earning if it were in a competitive savings product. The current term deposit and high-interest savings account market in Australia in 2026 offers rates of between 4% and 5% for most terms. If your money is sitting in a basic savings or transaction account earning less than 1%, moving it to a competitive savings product does not change your Centrelink assessment $1. Centrelink deems you the same income regardless, but it does mean your actual income from those savings is now higher than the deemed rate, which is far better than the alternative. The second strategy involves understanding which assets are subject to deeming and which are not. Not all your assets generate deemed income. Your principal home is completely exempt from the assets test and is not subject to deeming under the income test. Physical assets like your car, household contents, and personal possessions are included in the assets test at market value but are not subject to deeming for the income test. Investment properties are not subject to deeming. Instead, the actual rental income from an investment property is assessed directly as income in the income test. This distinction is important because it means the income test and assets test treat different asset types differently, and understanding which types of assets generate deemed income versus actual assessed income versus no income assessment at all is the foundation of any effective financial structuring strategy in retirement. The third strategy involves the potential use of your principal home as a legitimate financial tool. Your home is exempt from both the assets test and the income test. Every dollar invested in your home, whether through renovation, maintenance, or mortgage repayment, moves from the assessable deeming environment into the completely exempt home environment. This is not a complex financial maneuver. It is simply an understanding that money spent on your home has different Centrelink consequences from money sitting in a bank account. A pensioner with $50,000 in a savings account being deemed at 3.25% on most of that amount is having $1,371 in deemed income generated from those savings. If they spend $20,000 of that on a legitimate and needed home improvement, their financial assets drop by $20,000, their deemed income drops accordingly, and their home, which remains exempt, is worth more. The pension impact of reducing the savings balance by $20,000 is a reduction in deemed income of approximately $650 per year, which translates to an increase in pension of approximately $325 per year under the income test. The home improvement is also generating real value in the exempt asset. The fourth strategy involves funeral bonds and prepaid funeral expenses. Funeral bonds up to $15,750 are completely exempt from both the assets test and the income test. They are not subject to deeming. If a single pensioner moves $15,750 from a savings account into a compliant funeral bond, those funds are removed from the deeming calculation entirely. The pension impact of that $15,750 under the upper deeming rate of 3.25% is approximately $511 per year in assumed income. Removing $15,750 from the assessable pool therefore reduces the deemed income by $511 per year, which improves the pension by approximately $255 per year under the income test. That is real money for doing something that has genuine value regardless of its Centrelink implications. The fifth strategy involves superannuation for people under pension age. If you are under 67, your superannuation in accumulation phase is not counted in either the assets test or the income test. It is completely invisible to Centrelink. This means that for people approaching retirement age who have excess financial assets sitting in savings accounts, contributing those funds to superannuation before reaching pension age moves them from the assessable deeming environment into the exempt super environment. The contribution must comply with the superannuation contribution rules, including the non-concessional contribution cap of $130,000 per year or $390,000 over 3 years using the Bring Forward rule from 1 July 2026, and the decision must be made carefully in the context of your overall financial and estate planning situation. But for the right person in the right circumstances, contributing excess financial assets to super before pension age can significantly improve their Centrelink position from the moment they reach 67. The sixth strategy is the one that most pensioners overlook, and that requires the least financial engineering of any of the approaches I have described. It is simply to make sure that every assessable financial asset you hold is accurately and currently recorded in your Centrelink declaration through MyGov, including any debts that can legitimately reduce the net assessable value of those assets. Any debts owing on assessable assets other than your home are subtracted from the market value of those assets for the purposes of your assets test assessment. If you have an investment loan secured against an investment property or a margin loan secured against a share portfolio, the outstanding balance of those loans reduces the assessable value of the corresponding asset. A pensioner who holds a $200,000 investment property with a $50,000 investment loan secured against it has an assessable asset value of $150,000 for that property, not $200,000. If your Centrelink declaration shows the gross value without subtracting the debt, your assessable assets are overstated and your pension may be lower than it should be. Now I want to address a question that comes up frequently from pensioners who are concerned about the deeming rate increase, and that is whether there is any possibility that the rates will be reduced in the future and whether waiting for a reduction is a viable strategy. The honest answer is that deeming rates respond to broader interest rate conditions. Fast forward to March 2026 and the cash rate is 4.1% at the time of writing, while the top deeming rate will be 3.25%. In other words, today's retirees are in front on the deeming rate game. This means that the current upper deeming rate of 3.25% is actually below the Reserve Bank cash rate of 4.1%. For pensioners whose actual savings are earning competitive rates of 4% to 5% on term deposits or high-interest savings accounts, the deeming assumption of 3.25% is more favorable than their actual return. The deeming system was designed to be broadly fair across different interest rate environments, and at current rates, most pensioners with savings in competitive products are not being disadvantaged by the income test relative to their actual income. The pensioners who are being most disadvantaged are those with money in low-interest transaction accounts or basic savings products that are earning significantly less than the deeming rate assumes. Now let me also explain how deeming interacts with the assets test, because I want to make sure the full picture is clear. The assets test and the income test run simultaneously. Centrelink calculates your pension entitlement under both tests and pays you whichever result is lower. For many pensioners, one test is the binding constraint and the other is not. For pensioners with very large financial asset balances, the assets test is typically the binding constraint because the assets test reduces the pension by $3 per fortnight for every $1,000 of assessable assets above the lower threshold. For every $10,000 of assets above the lower threshold, you lose $30 per fortnight, $780 per year in age pension. For pensioners with more moderate financial asset balances whose assets sit below the full pension threshold, the income test through deeming may be the binding constraint. Understanding which test is currently reducing your pension, or whether both are in play simultaneously, is essential for knowing which strategies are most worth pursuing. There is also a nuance around deeming that applies specifically to older account-based pensions that is worth understanding. Account-based pensions that were started before 1 January 2015 and where the holder has continuously held a relevant concession card since that date are assessed for the income test based on their actual drawdown amount, rather than the deeming rate. This is called grandfathering. For pensioners who hold these older products, switching to a new account-based pension product would trigger deeming on the new product, potentially increasing their income test assessment even if the underlying balance is the same. If you hold a pre-2015 account-based pension, do not switch products without understanding the income test implications of doing so. Now, let me walk through what you need to actually do this week based on everything we have covered. The first thing to do is calculate your total financial assets accurately. Add up every bank account balance, every term deposit, every managed fund, every share portfolio, and your superannuation balance if you have reached pension age. Write down the total. This is your starting point for understanding your current deeming situation. The second thing to do is calculate your current deemed income using the 1 July 2026 deeming rates. Apply 1.25% to the first $66,800 of your total financial assets for a single person, or $110,600 for a couple combined. Apply 3.25% to everything above those thresholds. Add the two figures together to get your total annual deemed income. Divide by 26 to get the fortnightly figure. Compare that fortnightly figure to the income-free threshold of $226 for a single person or $396 combined for a couple from 1 July 2026. If your deemed income is above the free area, calculate how much above it is and multiply by 50 cents to find your fortnightly pension reduction from the income test. The third thing to do is check what your financial assets are actually earning. Look at every bank account, term deposit, and savings product and find the current interest rate. If any account is earning significantly less than 1.25%, you have the option of moving those funds to a more competitive product. This does not change your Centrelink assessment, but it closes the gap between what Centrelink assumes you are earning and what you are actually earning. The fourth thing to do is check your Centrelink income and assets declaration through MyGov. Verify that every financial asset is correctly listed at its current value. Make sure any investment debts are correctly shown as reducing the assessable value of the corresponding investment assets. If anything is incorrect or outdated, update it within 14 days as required by law. The fifth thing to do is review whether any of the legitimate strategies we covered today apply to your situation. Do you have surplus cash that could be directed to a needed home improvement? Have you considered a funeral bond up to the exempt limit? Are you under pension age with access to super contribution strategies? Do you hold any pre-2015 account-based pensions that have grandfathered income test treatment that you should be careful not to disturb? The sixth thing to do is speak with a financial information service officer at Services Australia or a licensed financial advisor who specializes in retirement income planning. The deeming system is one area where proper professional guidance can identify meaningful improvements to your pension position. The Financial Information Service at Services Australia is completely free. Call 132300 and ask for a Financial Information Service Officer. They can run through your specific financial asset position and help you understand exactly how the deeming rules are affecting your particular pension calculation. To wrap everything up, most Australian retirees do not realise their bank account is costing them thousands in lost pension because the mechanism by which it happens, the deeming system and the March 2026 rate increase, operates invisibly in the background of the age pension calculation. The connection between a bank balance and a pension payment is not intuitive. The fact that the assumed income from a bank account can reduce a pension payment even when the actual bank interest is lower than the assumed rate is genuinely counterintuitive. And the fact that where you hold your money matters as much to your pension as how much you have is something most Australians have never been told. The good news is that understanding the system is the first step to managing it. And the strategies available to legitimately reduce the pension impact of financial assets are accessible, legal, and worth knowing about. Your money should be working for you in retirement, not quietly funding a pension reduction you did not know you were paying. If this video helped you understand something important about how your bank account affects your pension, please give it a thumbs up because it genuinely helps more Australians find this information when they need it most. Share this video with every pensioner you know who has significant savings, because the March 2026 deeming change has already affected their payment and most of them have not figured out why. Subscribe to Centrelink Insider AU because we are here every single week covering everything that affects your retirement income in Australia. And drop a comment below and tell me whether you knew about the deeming system before watching this video, and whether the March 2026 change has visibly affected your pension payment. I read every single comment, and your questions shape what we cover next. Until next time, stay informed, stay protected, and make sure your money is working for you.